So good morning, everybody. I'm Jordan Metzger, a partner at Schotz in the real estate group. We're an AmLaw 200 firm. We have offices in New York, New Jersey, Baltimore, Delaware, Texas, Florida, and Washington, D.C. We have about 40 lawyers in our real estate group. We have a local and national footprint. We're doing everything soup to nuts in the real estate market. We also have groups in environmental and construction that supplement our practice. And we're also working with our bankruptcy and litigation folks on restructurings and workouts and debt buys and foreclosures and things of that nature. So let's go down the line, do some introductions, and then we'll get into the meat of it. Andrew.
Great, thanks. Andrew Kurd, Managing Director and Head of New York with the Davis Companies. Davis is a vertically integrated company with a full operating platform and also a fund manager. We're currently investing out of our fifth fund, which is just under $1 billion. We invest nationally across all asset classes, and then predominantly really up and down the East Coast. To date, and we can get into it, we have a number of investments already in New York City. And we are very focused at growing our platform here, over the next many years. So I'm happy to be here.
Hi, Brandon Polakoff. I'm the head of New York City investment sales at Avison Young. So we have 5,000 employees across 120 offices across the globe. Our team here is about 24 people. We work on the sale of all, like the major food groups, so multi-development, retail, office. And thanks for having me.
Good morning, everyone. Albert Schmool, Managing Director and Head of New York Region Acquisitions for Tishman Speyer, investing across asset types and across the risk spectrum.
Samir, Tejpaul, Managing Director and Head of Capital Markets at Madison Realty Capital. Today we're about a $23 billion investment manager focused on all things CRE, vertically integrated with development capabilities. You all probably know us more so from our lending activities. So this year we're tracking towards about $6.5 to $7 billion of lending across 60 deals. On the flip side, we're also in the marketplace to dispose of resi, for sale condo, and single family in the tri-state. So I think it'll be a fairly dynamic conversation from a debt and equity lens today.
Morning, everybody. Mike Tortorici, Ariel Property Advisors. I'm one of the founding partners. We're a commercial real estate services firm, 3 divisions, investment sales, which is what I do, capital services, and research. I'm sure a lot of you have read our research reports covering the New York area, different product types, very active in the multifamily development and commercial real estate spaces around the city. Thanks, and great to be here.
So as you guys can see, we have good representation on the debt side, the equity side, and from the brokerage community, so we're going to cover all of those bases. Our topic today is investment sales outlook, keys to successful transactions amid fluctuating interest rates. So we'll talk debt, we'll talk equity, we'll talk market observations and prognostications. So we're seeing a bit of a market reset. And a lot of the shops in the city are angling for acquisition opportunities. Let's start from the brokerage side. Brandon, how do you see competition and pricing?
Sure. So competition has finally, I would say, picked up. If you've heard me speak before, I go on a fun meter, so very fun right now doing what we do. If you look at, I guess, just anecdotally, right, so typically what you see is pricing kind of hits a low, and then activity picks up, and then pricing follows. So we're on pace for 44 sales this year. I think the things to note are that 37 of those properties closed in the second half of the year. Post-primary, we're under contract for another 19 properties. 9 of those signed after the primary, and we have another 18 contracts out. So what does that tell you? It tells you that people are back and buying. I would say, to kind of compare it activity-wise, it feels the most like the end of 21 into 22, kind of coming out of COVID when rates were still low. The major asset classes driving it, you're seeing a huge uptick in development. Multifamilies kind of remain consistent, and then you're seeing more office sales and a little bit more retail as well.
Michael, you're a little more active in the boroughs. What are you seeing on that note?
Very active year. We're doing a fair amount in Manhattan, but the Bronx is doing great business right now. even with rent stabilized properties being tough to sell, we're selling some of those. Development sites up there are trading at $100 a buildable foot, which we don't see all day long. Brooklyn is also a hotbed of activity for our firm. My partner Sean Kelly's doing a ton of business in the Gowanus area, selling development sites. MIH is not a burden in the Gowanus. We're seeing $250, $275 plus a square foot on a lot of those sites. Upper Manhattan and Manhattan, Upper Manhattan is lagging a little bit. In terms of activity, the rent stabilization laws really did a number on sales activity up there, but we're starting to see some real recovery. Overall, I think we're on pace right now to see about $30+ billion in sales for the year across all asset types in the city, and that's a little bit better than last year. Not great, but I think we all feel the momentum on the listings that we have. What I'm noticing is every Monday morning we have a company-wide meeting. We go over everything that we're working on listing-wise, everything that is in contract sold, and the consistent theme that I'm seeing is the types of sellers, the profile of the sellers is fairly consistent. It's people that have debts coming due clearly and are selling assets to unlock equity to cover other opportunities. It's changes in family dynamics. We've got a ton of baby boomers that are moving on and retiring, and many times their families don't want to manage the assets in New York, so it's a decision of either consolidating and rethinking what they want to actually keep in New York, or taking it out of the city, diversifying to less management-intensive properties. And then lastly, I'd say nonprofits that are asset-rich but have cash needs, they're also doing a lot of work right now. City of Yes has freed up a lot of development opportunities for them. So those are really the three food groups that we're seeing of sellers that are meeting the market today.
So let's segue, Albert, to the principal side. What are you seeing in terms of your buying opportunities and competition and pricing?
Sure. I think the activity in the capital markets has kind of trailed the activity in the leasing markets, particularly on the office side, where 12, even 24 months ago, leasing activity was really strong for the better buildings, up until the point where those pretty much ran out of available spaces, and the interest has then started to kind of shift down to the next tier and the next tier. The capital markets is viewing buildings and activities the same way, in which case the best buildings that have hit the market, 590 Madison, Park Avenue Tower, et cetera, even 12 months ago, 799 Broadway, those have had fierce competition, and we've been involved in bidding on almost all of them. We're fortunate enough to win one, in Soho this summer, but there's a stark comparison to the bottom end of the market, where buildings that don't have as much traction on the leasing side, that need a lot of capital, that have a lower eventual ceiling, even with capital, face a lot less interest. And so I think it's been a bit of a tale of two cities, particularly in the office market. And our expectation is, as the market continues to evolve, much the way the leasing market evolved, that capital markets competition will continue to cascade down to kind of lower and lower tiers. And I think we're just a little bit ahead of when that eventually flips.
So I think we'd all agree that the bid-ask concept has been evolving over the last 6-12 months. Andrew, maybe talk a little bit about whether you see that gap narrowing, and if so, what does it do for opportunities? Or sellers still holding firm, or are you seeing some movement that will create more activity in the marketplace?
Yeah, sure. So I think, definitely compared to 12 to 18 months ago, the bid-ask spread, has tightened. I think what's interesting, at least to us right now, what's happening in New York is you have this convergence of the market improving, as Albert mentioned, in the leasing, on the leasing side, the activity, it's very clear. You look at all the numbers, the rent levels, that the market is improving, while at the same time, this bid-ask spread is tightening, and certain owners and lenders that 3 years ago did not have to transact are at the point where they have to transact. So it feels like there are a number of deals in the market. It is very competitive, but you have this convergence of fundamentals clearly improving, with sort of transactions now having to happen. And I think over the next 12 to 18 months, that will only continue. We recently recapitalized 630 Third Avenue, which we're very excited about. Felt like that was exactly what we were seeing in this Grand Central submarket. It's very clear what's happening on the leasing side. If, you position your building, like it was discussed earlier, the right way to attract tenants, and that's amenities, renovated lobbies, really create that tenant experience. And if you do that in the right location, and then also think about the supply-demand imbalance with all these office to residential conversions happening, there's a really attractive investment opportunity in that space.
Brandon, how about from the brokerage standpoint? Bid-ask narrowing?
Yeah, definitely. I think Albert hit on something important. So, and Mike did as well. So going back 10 years ago, we sold 80% of what we put on the market, right? So pretty much anything that was reasonable sold. Today, as Mike mentioned, right? So I always say there's like 4 Ds, which other people reference. So debt, dispute, divorce, debt. If you don't have one of those 4 and you're like an okay asset, you're probably not going to sell. If you are discretionary and you have an A+ asset, you will be able to sell it. So that's probably the biggest difference you see today is, yesterday I actually turned down an assignment where it's an okay location, discretionary seller. Doesn't really make much sense to work on that today. But if it's an A+ building, let's get after it because we'll find a buyer.
Michael, same in the boroughs in your experience?
Yeah, I think if something's priced right today, there's a deep audience of buyers for it. It's just a matter of if the seller's going to meet it. I mean, lending is active right now. We're selling. We had a multifamily deal, prime Manhattan, that we took out to market back in September, and within 2 weeks we had, I think it was 12 or 13 offers on it right out the gate, and aggressive offers too. We're like approaching the asking price. So if it's priced right, to Brandon's point, there's enough motivation out there among a lot of parties that if a broker prices something right, you'll meet the market, you'll create a great process, and the price won't get necessarily pushed to the outer limits that it used to be, but there's a very strong base, and then you can negotiate it up from there.
Okay, thanks. Samir, you've been very patient, so we're going to pivot to capital now.
I just think taking all of the feedback so far.
By the way, before you start, congratulations, number 9 in 2025 with under $1 billion of loan volume. Congratulations.
It's been a great year. So I guess taking all the feedback in that I've heard and my perspective on it is we're all looking for data points, right? So you're coming out of a high inflationary environment where those data points are few and far between. So what does that mean? The bid ask is very, very, very wide. Right, and as we've evolved over the last 2.5, 3 years, the bid ask becomes much more palatable. And my perspective is the ask is much more realistic. So if you have somebody coming to market for those, call it 4 Ds, they have the data, the advisory world has the data, they're empowering their client, they're giving a perspective, they know where the market's going to clear. And what does that lead us to? More transaction activity. So 2025 has been an outstanding year for almost every asset class from the perspective of things have traded. You had very large hotels in New York City trade. You had the Dominic and you had the Addition. You've had multifamily across the tri-state trade, whether it had assumable debt or not. You've had industrial get traded and or developed. You've had mixed-use retail outperform in many, many ways in the outer boroughs. We'll hold the affordable stabilized off to the side. We have more data points. It's a more dynamic marketplace. A lot of this, and from my perspective as lender first, the debt drives the execution. So it's much more palatable to go out and buy $1 billion office building if you can borrow money at 5.5%. You're generating a positive cash on cash. There's probably 0 people in this room that are going to buy something in New York unlevered. Leverage is much more compelling today than ever. There's more competition in debt than ever. Debt is setting the tone for the market. You are now buying things where there's positive cash flow. You're not taking on negative leverage. All of these data points are very positive signs going into 2026. I would imagine volumes are going to be, speculating 25 or 30% higher next year than they are this year. My hope is it's even higher than that because, again, those data points are going to empower more activity, more transaction volume, and I think everybody up here will benefit from it.
I just add, even the rent stabilized, there are data points there too. the range is very wide, but you're looking at, and it really varies from building to building based on how tight the revenue is versus where the expenses are. But you're looking at declines of between 30, 50, and 60%. It's very much building to building, but there's a lot more data today than there was even 2-3 years ago.
So yeah, to that point, the marketplace knows what the ask should be if you're trading something like that. There was a very big dispersion of perspective 3+ years ago about where things were going to trade. We're just at the cusp, I think, of it kind of opening the floodgates for that activity.
So, Samir, what kind of challenges are you facing in terms of underwriting based on everything that you just outlined for us?
There are parts of the boroughs where there's just a tremendous amount of supply. We're really big believers of Gowanus, but you created a market out of nothing there over the last 5 to 10 years. So you're adding 5, 6, 7,000 units, unproven location, unproven pace of lease up. Rents are at all-time highs. There's definitely concessions being offered. I think we're actually retrenching, and we're saying, look at Manhattan, where you have zero to little construction starts in the housing space. Market rate rentals are going to go through the roof. The direction of city and state legislature and politics is they're disincentivizing market rate development without more incentive around it, and we're going to see rents run a little bit more. My vantage point is investment sale activity in Manhattan, in particular amongst the resi markets, should be an outperformer next year, particularly if you want to write checks of scale, which is something we talked about before this meeting.
Well, you commented when we spoke in preparation for this panel that you said that New York City is the only place for big deals. What did you mean by that?
This is the capital of real estate finance, real estate investment sales activity. Commercial real estate perspectives set the tone here, and then they emulate elsewhere or move elsewhere. The $150, $200 million acquisition or financing in pretty much every other market across the country is a top 3 to 5 transaction, maybe the largest transaction. I don't think a $150 or $200 million deal in New York City cracks the top 10. It clearly doesn't if you just follow the data points. We're chasing big deals. We're not scared to go after the small stuff, but again, New York City sets the tone. Investment sale activity, lenders, they like to do deals of scale. It's the same amount of work as doing a $250 million deal as a $25 million deal. And New York City continues to be the capital for large investments within commercial real estate. And it's very hard to say what's the next leg down after that. My hope is with this turning, you'll see larger deals start to trade in other markets so that we can maybe balance out our portfolio outlook.
Yeah, I think you're echoing Tony Malkin's comment earlier that New York is sui generis. So I think we're pretty much in agreement with that. Albert, on the principal side, as a borrower, tell us about what you're experiencing in terms of how you're getting creative in the capital stack that you're putting together in order to make acquisitions work.
Yeah, sure. I think, look, there's a number of different ways that transactions can come together, and we're very fortunate. We, even in tough markets and over the last couple of years, we have a lot of deep lender relationships that have been there. Now, the cost reflects their cost of capital as well, so that has to be a factor, but the availability of debt has not really ever been something that felt to us unreachable. That said, it's all a function of price. And so depending on what type of financing you can get, that ultimately is driving the price we can afford. And in some cases, some deals that we like, we've been able to get more constructive on price because the seller or the existing lender was willing to offer some financing. Not high leverage, we're not really typically high leverage players, but still a function of meeting our return requirements, which are markedly higher than where they were 4 years ago, is a function of that debt. And I think Samir touched on something interesting, and I think it relates to your last question about the bid-ask spread. Certainly there's been more realistic expectations from the seller side, which have helped. But there's also been some increase from the bidder side, and I think part of that is if you are seeing something, whether it's in the data or in your own portfolio, a lot of people's expectation is that the market will continue to get more active and more deals will get done, and that pricing is only going to get higher from here in this part of the cycle. And so I feel, personally speaking, it feels that in almost all asset types, the bottom is already behind us. And so if you're going to lean in and you want to be active in this cycle, it's only going to get more challenging. And so I think that's also been a way for a lot of folks that are on the bidder side to be more constructive, and that's helped bring that gap.
And are you folding in mezz and pref in order to get to where you need to be competitive in the market, or?
I will say that that's not typically our MO, right? If a deal doesn't work but for layering on some high octane pref, it's probably not a deal for Tishman Speyer.
Andrew, how about you guys at Davis?
I'd say the same. It's almost the opposite. We're making sure that any transactions we're looking at, we're very protected on the debt side in terms of term and rate and structure. But it just comes back to really what are we focusing on, in which asset classes and why. And I think across office, retail, multi, in New York, the foot traffic is very clearly there. You walk the streets and it's evident. Talent wants to be here. But in terms of how we're capitalizing deals, no, we want to make sure we're not going to just make a deal work by the leverage that we're putting onto it.
Jordan, I would say actually on that point, what I've experienced and I've seen in the last 6 to 12 months is less financial engineering with additional subordinate debt on acquisitions of existing assets or even bridge deals that have some ramp to it. I'm seeing more of that in the construction space, where they're not able to circle that common equity to the yield on cost they're solving for, and they'd rather solve it with that 80 to 85% of cost, junior mezz or pref. So that's where I'm seeing folks use the financial engineering more.
And there are financing sources in the market?
It's extraordinarily deep. I mean, if you're an equity player and you have not established and or spent time in debt over the last 4 to 5 years, I can't say you've been doing much outright, but I think debt, and particularly higher LTC debt, has become a very good hedge for a lot of equity players because it affords them very good IRR. It could be a very short recyclable window where they can redeploy that capital as the equity markets improve. They sacrifice some minimum multiple to do that, but it's a good barbelled approach. And it keeps them active and it gets them those data points they're looking for to get really back to their core competency, which is buying value add or core plus sort of assets they want to own for 5, 10, 15 years.
So let's pivot to Brandon, one of your Ds, distress. We're seeing a fair amount of that in our shop in terms of restructurings and refinancings. We're handling senior loans and UCC foreclosures on the borrower and the lender side. Andrew, what are you guys seeing in terms of distress opportunities? What are you chasing?
Yeah, look, I think there's certainly distress out there. If you look back for years, anybody that was transacting in the real estate space before interest rates spiked has issues within their capital stack. So there, I'm sure everybody is on this panel is seeing there are lenders that are either have a lender for sale of assets or are driving sort of the recapitalization of assets. In some cases, there's seller financing offered. So I think, a number, and it's really across, obviously in office, there is probably a disproportional amount of that, but it really is across almost all asset classes because, when you're investing in real estate as an asset class, which is, generally, more levered than other asset classes and interest rates spike, that's what happens. So I think there's definitely a prominence of that happening in the market.
Samir, are you experiencing distress in your portfolio?
Yeah, I think we've been lending for 20 plus years. We've been active in every cycle. We'll continue to be active in every cycle. It's a business, not a trade. And yeah, look, it happens. Some people's business plans don't go the way you originally underwrote them. And we're not afraid to step in and enforce. And that'll be the case moving forward. I think the perception of Madison is one of whatever you want to say 5, 10, 15, 20 years ago. Our perspective is we're lenders. We want to hit singles and doubles is my baseball analogy. We want to get on base and let the equity get us home. But we have to call an audible, we will. I don't particularly see an uptick of distress this year any more than the year prior or the year prior to that. I think everybody's expectations are and perspectives are folks are coming to the table and the ask from the equity side is we understand the situation. We'd rather play ball than make it frictional.
Yeah, Brandon, I think you guys have a little bit of a capital markets presence. Are you guys brokering any loans at this time? Michael, too, maybe you can comment on that as well.
Yeah, so we, Andy and Scott Singer at our firm, they just closed a very large-scale multi-loan last week. So they're doing a lot of debt in the development space as well as the multifamily space and some in office as well.
Yeah, same. Multifamily development, and what I keep hearing from our capital service team is that there's just a lot more capital out there, particularly in the bridge space, that's looking to fill the gap right now.
What are you guys seeing? Let's talk about institutional investors, pension funds, family offices, things of that nature. Albert, you're a fairly large investor in New York. What's your experience in terms of acquisition opportunities and, given the size and breadth of your shop, your ability to execute?
Yeah, sure. So I think the composition of the competition that we've faced has evolved pretty materially over the last couple of years. And for the first time, or at least in force this year, I think you've seen the high net worth and family offices, which were kind of the dominant players in competition on bid sheets, start to be only one of the groups that are active. And I think it varies a little bit by asset type, but in office, which is where we spend a lot of our time thinking about, we're going up against the usual suspects that you'd think we'd be competing against, and historically we have. And you look at the last 5 or 6 large transactions for office in New York, and you have a lot of New York, focused players that have huge portfolios and have all the data, which I think is a pretty ringing endorsement for, the health of the leasing fundamentals. I think backstopping that is a lot of more interest and willingness to come off the sidelines from a lot of the groups like pension funds, sovereign wealth funds, et cetera, that for a couple of years, for a whole host of reasons, were on the sidelines. Whether that was office, multi-industrial, there were heavy concentrations in their existing portfolios. They had some issues that they had to work through from legacy assets, and I think a lot of that work is finally behind us. And with the fundamentals, I think the first wave of pensions and large institutional investors are already here. And I think as more data points continue to build, more and more of that capital, my expectation is, will continue to come into the market.
Yeah, we know you're very active in office. Are there any other asset classes that are whetting your appetite these days?
Sure. In fact, we bought a 200-unit multifamily building in Montclair, New Jersey in April. That was a great deal we were very excited about. Elsewhere throughout the country, we've been active in multifamily and industrial. In New York, we bought an office building I mentioned earlier, and I think there are several other markets that we're interested in from the office perspective throughout the rest of the U.S. Industrial, we were very active in kind of 22, 23. So I think some of the perspective is kind of harvesting those development deals and existing buildings, but I think we're still looking to put more on the board. And I think now we've got a big life science platform called Breakthrough that also was super active and has some deals that have recently leased up and developments that are completing. I think that group is kind of licking their chops now that life science leasing demand has taken a bit of a hit to pick off some assets that they've had their eyes on.
How about data centers? They seem to be filling the gap created by a little bit of a slowdown in life sciences. What are you seeing there?
Yeah, so I have to say I'm probably most naive on the specifics of the day-to-day data center market. We've got a separate team within the firm that's kind of building the strategy and thesis there across the country. My expectation is that New York City and the immediate surrounding is unlikely to be the epicenter of large development. But look, I think it certainly has a ton of activity and a lot of reasons to believe that the demand side will continue. And if that's there, then the rest of the ecosystem for development, et cetera, should continue to roll.
Andrew, data centers, are you in?
I think so. We're evaluating the data center space. I think we're certainly trying to figure out where it makes most sense for us to participate in it. When you dig into it and read about it, the numbers are really eye-popping. But there's obviously, an incredible momentum to AI and how it's going to affect many aspects of your life. So we're evaluating it to see where it makes most sense for us to participate.
Samir, you lending on data centers?
Specialty asset class, I think it straddles the infra CRE world. When you're underwriting these deals, you're really underwriting the corporate credit behind the transaction. So some people would say getting paid a 50 to 75 basis point premium to lend on a Microsoft data center in Ohio is great relative value. The corporate credit world would say, I don't know nothing about real estate. I'm all in on the corporate credit. We're a little bit more risk off, I would say. Talk about check sizes. I mean, data centers make everything we do look like baby investments.
Us too.
Yeah.
So room to grow, right?
Certainly. Yeah.
Let's talk a little bit about what's going on just locally. Not necessarily want to get political, but what are you guys seeing in terms of the fact that interest rates have come down, the fact that we just had an election? How are you guys seeing that's impacting investment activity in New York? Michael, you want to start?
Sure. So, I mean, Anthony Malkin on the previous panel said that since the mayor election, his leasing activity has been strong as ever. And one of the things that stuck out to me is that since even the primaries back over the summer, when it became apparent that Mayor Mondami would be the lead runner anyway, none of our development site sales at all skipped a beat. And we put a whole bunch of stuff in contract on that side. The free market side as well, value add as well. We haven't seen any real pullback in activity, any real pullback in interest, pricing. It's all been very consistent. Where things are a little bit more trepidatious right now, clearly are rent-stabilized properties because the rents are going to be frozen for stabilized buildings, and it's going to throw a whole wrench in the works for that pricing even more. But at the same time, the market for that has been down for 6 years now, hard to believe, since 2019. So, anyone that's trading that right now anyway is seeing huge discounts. The values aren't going to get any better, and there's a level of acceptance among sellers that they need to figure something out with that property, and that's just going to continue. One of the things that is a little bit concerning is there's this new proposal in the city council TOPA. I don't know if anyone's heard of those, where they introduce 120-day period that gives nonprofits the ability of a first look at a building that's 3 units and up for sale, and also some element of ability to match pricing if it goes out to market. And if that happens, there's going to be a whole period again of how this process evolves, how people market rent-stabilized buildings, what process they need to solve so they make sure that they're in compliance. And it's going to be a period of slowdown again for these types of buildings, and we'll all just have to figure it out as we've had to do. One of the things I've noticed in stuff that we sell rent stabilized is that there hasn't been a lot of demand from nonprofits for these buildings. We would love to sell to nonprofits if they're out there and submitting offers, but more often than not, it's typically family offices with deep management platforms that can run these versus some other new entrants that are in the wings.
You would think that with the tax benefits, that in order to the benefit of nonprofits, that you would see a little bit more of a demand. Brandon, are you seeing anything in that space?
Yeah, I mean, I think we've talked a lot about rent growth and rent stabilized versus fair market, and I think the reality, which no one really wants to talk about, is the underbelly of the multifamily world, which is paperwork. It has become incredibly difficult to navigate all of the different laws tied to how units were deregulated. The way that the city has ruled on a lot of this stuff, it's made it very tricky to understand the risk level of a building. And you even ask an L&T attorney, they'll give you 3 different answers. My Spotify top list would all be L&T attorneys. I speak to them on a daily basis. I'm personally going out getting affidavits from tenants back in the 90s, from contractors who are in the Bronx. These are things you have to do if you're a deal junkie to get stuff done. But there's there's really no upside, right? If I'm a landlord-tenant attorney to say, hey, it's definitely okay, right? You want to be careful. So they're going to tell you what the risk is, and then it's the buyer's decision. But that's honestly what holds up a lot of sales. So I think having the institutional world come back in the multifamily space is very important. A lot of those buildings are post-1974. If they're subject to rent regulation, it's due to an abatement, not because a unit was locked up over 6 units back in the 70s. So that's been the really big challenge. I think you would actually have seen a much larger uptick in multifamily sales this year if not for paperwork. I can tell you anecdotally, I've had at least a dozen deals die, and it's a lot of work going into it, and you kind of have to live with the result.
Okay, so we want to leave a little bit of time for questions and answers, but let's do a little lightning round to finish up. Crystal Ball 2026. Michael.
I like what Samir was saying earlier about Manhattan development. I'm very bullish on it. I think that's one of the underpriced properties that are out there right now. We've been bouncing along the 400, on average, the average price per buildable square foot has been around $400 a square foot, give or take, since about 2020. This year, it's going to be about $480, $500 a square foot, I think, on average. And that's still well below peak pricing for that product type. It used to be in the $600, $650 a buildable square foot level. Other parts of the city fairly quickly recovered on a price per buildable basis. So I think there's a lot of room to grow in Manhattan development site sales.
Samir, Crystal Ball 2026.
Let's put it all out there. I think 26 volume sales will be double what they were in 25 across all asset classes.
You heard it here first. Albert.
I'll go with another hot take. There will be more new office development by square footage than multifamily in Manhattan.
Wow. Brandon.
Those were all really good. I'm going to stick to, I'm just going to copy Mike. Development. I think we have had tremendous success. It's also nice not having to get into the underbelly of the Manhattan multifamily world. Selling development. So we just closed on a sale north of $1,000 a foot. Sent out a contract yesterday. Large scale site, Manhattan Prime, over $900 a foot. I think you're seeing people pretty bullish on, and then we just brought some sites out in Midtown South, and the activity demand is incredible to build rental. I think that's going to drive a lot of the market this year, along with the institutional, asset classes these guys talk about.
Andrew, Crystal Ball.
Yeah, no, I share. I mean, I think the transaction activity in 2026 is going to be very, very strong across all asset classes. I think it's, I was saying earlier, I think there's this confluence of fundamentals continuing to get very strong and transactions having to happen. So, I think in New York, the talent wants to be here. Capital flows will continue to come back. So I think it's going to be a very, very active year, in my opinion.
Great. Thank you, panel. Questions for the panel?
Hi, Kara Long, one of the reporters with Bisnow. I have a question for Michael. You said that rent-stabilized properties in the Upper West Side are not doing great, but the Bronx are. Can you tell me why there's that differential between those two?
I don't think I mentioned anything about the Upper West or the Bronx particularly.
It was right at the beginning. You did.
I might have then I may have misspoke. What I was saying was I think transaction volume.
Yeah, that's what I'm
transaction
asking about.
volume. So the Bronx. Okay, I think I was talking about a couple different things. If I could regroup you after, I'd be happy to clarify that. So.
All right.
But thank you for paying close attention there.
Anyone else?
You guys should chat after, definitely. Raise your hand if you got a question. Double the transaction volume in 26? Who's got questions? Come on, these are hot takes. Raise your hand. No one's going to bail me out. There you are.
When we do our state of the markets and no one asks questions, we just make them up.
Hi, good morning. I was wondering, have you seen debt terms as debts come back into the market? How have terms changed to align with the new market conditions?
I mean, I'll go first. So I think if you want to talk about fixed rate borrower who's buying an existing building with cash flow and wants to perm it out for 5 or 10 years. First things first, most borrowers of deals of scale want to borrow 5 years because they think they're going to be in a better interest rate environment 5 years from now. Newsflash. Everybody's an optimist on rates. You're getting more leverage with better DSCR coverage because coupons have come down. I think generally speaking, we're probably 100 plus basis points tighter today as a fixed rate 5-year borrower than you were last year. So if you were borrowing at 6.5% last year, you're probably borrowing closer to 5.5% now, just generically. We're seeing a lot of fixed rate deals sub 5%, whether borrowers are locking it in there or buying it down with points. And then on the floating rate side, it's been a double whammy. So SOFR's come down 130 plus basis points, so that's all savings to a borrower. Generically speaking, spreads are probably in another 100 basis points. So for that opportunistic value add core plus buyer that sees upside in what they're buying, or maybe they're quote unquote buying cheap, you're saving $250 of rate debt service payment off the bat. So think about today's market. Give you an example. Somebody's buying a 7 debt yield in place, $150 million purchase on a multifamily asset in the tri-state. They're probably wanting to borrow floating rate, so a 5-year floater, 3-year initial term. SOFR floors are anywhere from 250 to 300 basis points, so you still get another 100 to 150 basis points of savings there. And then you're probably getting a quoted spread around 2 to 225 over. So in today's market, you're borrowing at 6 to 6.25. Going forward 2 years from now, if rates do step down, you're borrowing closer to 4.5% or 5%. That's pretty good outlook for someone who's putting equity to work and getting a cash-on-cash return day one with upside. So again, I talk about debt leads the marketplace on acquisitions. Look no further than floating rate debt's moved tremendously. And if you're a fixed rate buyer, you're probably borrowing 5 years because your outlook is the same as a floating rate. 5 years forward, interest rates are quote unquote better, but obviously who knows?
Question in the middle here.
Jack Sardar, Tri-State Commercial. First off, thank you, Jordan and all the panelists. Albert, I hate to put you in the hot seat. Just a quick question. Your 2026 prediction was, very fascinating to me. Did you have data for that, or that was just, you're focused on office buildings and you're just, really bullish on that?
Look, it's a feeling that's informed by what we do and what we see. It's an incredibly difficult environment for new multifamily development, particularly in zones A and B with 485X. Right, it's not a very accretive program, and in some places there will be some development, no doubt. My expectation for the office side is that after a couple of years of really very little to no supply, that we're finally going to see some sites that are primed and waiting get some anchor tenants that don't have a lot of options, even in today's market, let alone in a couple of years when they expect and need new space, to find big blocks of space. And so there are a few sites in Hudson Yards that are just waiting for the right anchor. There are a few sites even on Park Avenue, on Madison. And my bet is more than one, maybe more than two, actually launch and commit to go in 2026. And just by virtue of the square footage of each of those buildings versus multifamily, my expectation is, if you have 2 or 3 of those go, that's going to be more than the entire new starts for multifamily development.
Give these guys a round of applause. Well done. Thank you, guys.
Yeah, that's great. Pleasure.